Exchange-traded funds, or ETFs, and mutual funds are both popular ways for people to invest in financial markets. While they might seem similar at first, they work quite differently and serve different kinds of investors. Understanding these differences helps you make better financial decisions. An ETF is a collection of various assets like stocks, bonds, or commodities that trade on a stock exchange, just like a regular company share. This means you can buy or sell an ETF anytime during market hours. On the other hand, a mutual fund is managed by professionals who pool money from multiple investors and invest it in a mix of assets based on a specific goal. Investors buy mutual fund units directly from the fund company, not on an exchange. One of the main differences between the two is flexibility. ETFs can be traded instantly on stock exchanges, giving investors real-time control over buying and selling. Mutual funds, however, can only be bought or sold at the end of the trading day, based on the fund's net asset value, NAV. ETFs generally have lower expense ratios compared to mutual funds. This is because most ETFs are passively managed, following an index like the Nifty 50 or S&P 500. Mutual funds can be actively or passively managed, and actively managed ones usually have higher fees due to professional management. Another major difference is how the prices are set. ETF prices change throughout the day depending on supply and demand, similar to stocks. Mutual fund prices, however, are determined once daily after the market closes. When it comes to minimum investment, ETFs are usually easier to start with since you can buy even a single share. Mutual funds often require a minimum investment amount, which might vary depending on the fund house. For investors who enjoy a hands-on approach and prefer to control their trades, ETFs are a great choice. They allow you to make quick decisions based on market movements. Mutual funds, however, are ideal for investors who prefer a more guided and long-term approach. The fund manager handles all the buying and selling, making it convenient for beginners or those who prefer passive investing. Both options offer diversification, which means your investment is spread across multiple assets to reduce risk. Instead of buying individual stocks, you're investing in a basket of assets, lowering the chances of loss from a single company. Taxation also plays an important role. ETFs can be more tax efficient because of how they are traded on the exchange, which often results in fewer capital gains. Mutual funds, especially actively managed ones, may generate more taxable events due to frequent buying and selling by the fund manager. Liquidity is another factor to consider. ETFs offer high liquidity since they are traded throughout the day. Mutual funds, while liquid, have a slower redemption process, usually taking a day or two to receive your funds. If you're someone who wants to invest systematically every month, mutual funds provide the option of SIPs, systematic investment plans, which help you invest regularly with discipline. ETFs, however, do not usually offer SIPs directly. Both ETFs and mutual funds come with risks, just like any investment. The market value can fluctuate based on economic conditions, interest rates, and investor sentiment. However, spreading your money across multiple investments helps balance potential losses. In summary, ETFs are perfect for investors who want flexibility, lower costs, and real-time control. Mutual funds suit those looking for professional management, simplicity, and long-term growth without needing to monitor markets daily. Ultimately, both ETFs and mutual funds can be valuable tools for building wealth. The best choice depends on your goals, risk tolerance, and how actively you want to manage your investments.